40 cents of every dollar you put into the S&P 500 right now goes to 7 companies. 7. You think you own the American economy, 500 companies, every industry, the whole beautiful diversified machine. But the machine has been quietly rewriting its own operating manual, and nobody sent you the memo. What you actually own looks a lot more like a leveraged tech fund, with some healthcare companies stapled to the back for plausibility. And here is what makes this immediate and specific. As of early 2026, passive index funds control more than 50% of US equity market assets. That threshold has never been crossed before in the history of financial markets. We are running an experiment with no historical precedent, and the only way to know if this much passive money breaks the system is to wait for a crisis large enough to test it. That's what today is about. Not sell everything, not the crash is coming next Tuesday, here's my countdown timer. I want to walk you through the actual plumbing of how passive investing works at this scale, where the structural pressure is building, and what it means for someone with real money, hundreds of thousands of dollars in a 401k or an IRA, who is counting on this system to fund their retirement. Because the mechanism that has been pushing your portfolio up for the last decade is the exact same mechanism that will push it down, and it has no judgment about which direction it's going. It doesn't know when to stop buying, and it doesn't know when to stop selling. The escalator goes up, but the escalator can go down. Here's what I'm going to cover. 4 specific pressure points in the passive investing system. The behavioral trap that makes each of them worse than the math suggests, and 3 structural moves you can make right now that reduce your exposure without abandoning the core logic of why low-cost passive investing still beats almost everything else. I want to be clear about what I'm not doing. I'm not selling active management. I'm not selling market timing. This is a lazy investor channel. The goal is always the minimum number of decisions for the maximum amount of wealth. But lazy doesn't mean ignorant. Lazy means you understand the system well enough to build it right and then walk away. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan. And I only ask for your email to send the report, so I don't store any of your financial data link in the description. Think of the index fund as an escalator. An escalator is brilliant engineering. You step on, it carries you upward without effort, and you arrive at your destination having done essentially nothing. This is passive investing in its purest form. You let the machine do the work. You keep your costs near zero, and you trust the economy to be larger in 30 years than it is today. The escalator works because there is a constant flow of people stepping on from the bottom. In investing terms, that is new contributions. Every paycheck that gets deposited, every automated 401k contribution, every dividend that gets reinvested, that is another person stepping onto the escalator. As long as the flow continues, everyone on the machine moves upward. But the escalator only carries you up because of that constant inflow. It is not actually defying gravity. It is flow dependent. And here is what makes the current moment unlike any prior period in financial history. The escalator is now carrying more passengers than it was designed for. And we are approaching the point in the boomer demographic wave where more people will be stepping off the top than stepping on from the bottom. The escalator doesn't know this. It has no awareness of the shifting ratio. It just follows the mechanical rules it was built on. And the rules, at this scale, with this passenger load, with this demographic headwind, produce outcomes the engineers never modeled. That is the escalator. It comes back. In a few minutes, I'm going to show you something that should make you want to look at your actual fund holdings today. Not next week, but first, let me show you why the problem you think you have with index funds is actually the wrong problem entirely. Most people, when they hear index fund bubble, think the issue is that stocks are overvalued. The price to earnings ratios are stretched. The market is historically expensive. Time to bail. That is not the right frame. Overvaluation corrects itself over time. Companies either grow into their valuations or they don't, and the historical data is brutally clear that trying to time the market based on valuation metrics alone destroys wealth. The market can look expensive on every reasonable measure for a decade while doubling. Anyone who sold in 2012 because the CAPE ratio looked alarming watched the market triple before they were vindicated. The actual problem is not that the stocks are expensive. The actual problem is that the stocks are correlated in a way that is completely invisible from the outside. There was a financial advisor in Southern California in the late 90s named Gary. Gary was proud of his diversified portfolios. He had clients in technology, in telecommunications, in media companies, in internet infrastructure firms, different tickers, different logos on the prospectus, different sectors according to the brokerage software. Gary thought he had built something genuinely spread across the economy. What Gary had actually built and didn't understand until 2001 destroyed everything simultaneously was one single concentrated bet. He was betting that the internet would transform every industry all at once, permanently. All four of his sectors were downstream of that one thesis. When the thesis broke, everything broke at once. Not sequentially, not gradually, all of it together in the same weeks. The diversification was cosmetic. The underlying risk was identical across every position. Now look at the S&P 500 inches 2026. Apple makes hardware, but earns its real margins on services. Microsoft makes software, but its growth story runs through cloud infrastructure. Nvidia makes semiconductors, but its growth is entirely driven by AI capital expenditure. Amazon is retail and cloud. Alphabet is advertising and cloud. Meta is advertising. Tesla is a story. Different companies, different products, different customers, different logos. But when interest rates spike sharply, when AI spending slows, when U.S. tech regulation intensifies, or when the dollar strengthens and crushes foreign earnings, all seven of these names move together. Because underneath the surface, they are one bet. They are a bet that U.S. large cap technology will continue to be the dominant investment theme of the coming decade. That bet might be right. I'm not claiming otherwise. I'm telling you that you are making that bet whether you know it or not, and the word diversification on the tin is not describing what is actually inside. The cap weighting mechanism makes this worse with every cycle. And the elegance of the mechanism is part of what makes it dangerous. The S&P 500 is weighted by market capitalization. When a company's stock price rises, its weight in the index rises, which means the fund automatically allocates more capital to it on each rebalance. There is no upper limit. There is no rule that says we have enough of this company. If Nvidia's market cap doubles, your passive fund now holds twice the Nvidia exposure by weight. The fund did not vote on this. Nobody reviewed a balance sheet. It is pure mechanical consequence. So the more expensive a company gets, the more the passive machine buys of it. This is price-insensitive buying at a scale that has never existed before, and it creates a reflexive loop that should make you at least slightly uncomfortable. According to analysis from research affiliates, the 25 largest stocks in the S&P 500 now account for more of the index than at any point since the early 1970s. And unlike the 1970s, where that concentration was spread across genuinely different industries, oil, manufacturing, utilities, consumer staples, today's concentration is in one sector with one dominant growth thesis and one primary sensitivity to the same macro variables. That is the escalator, packing everyone onto the same step. Somewhere right now, there is a guy at a dinner party explaining that he is completely diversified because he has money in both the S&P 500 fund and the NASDAQ growth fund. His brother-in-law, who owns timberland and a grocery store franchise, is nodding politely and thinking about something else entirely. Now, this is where it gets really interesting. And I'd encourage you to stay with me because this next part is the one the financial press dramatically understates. I want you to think about what happens when the escalator reverses. The passive fund buying mechanism is elegant when money flows in the fund, receives cash, buys stocks proportionally, prices rise, everyone looks smart. But when redemptions happen, when people need their money back, the exact same mechanism runs in reverse. The fund sells stocks proportionally to meet those redemptions. It does not choose what to sell based on which companies are overpriced. It does not look at fundamentals. It sells everything in the same weights it holds them at whatever price the market will bear, in whatever volume is needed to meet the cash demand. In a small redemption event, this is invisible. Active buyers on the other side absorb the selling pressure and reprice accordingly. Everything is fine. But here is what has structurally changed. With passive funds now controlling more than 50% of assets, the ratio of active capital available to absorb that selling has shrunk. Think of it like a dam on a river. The river is passive capital. It flows in one direction, into the market. The dam is active capital, the buyers who sit on the other side and absorb the flow. The river has gotten dramatically bigger over the last 2 decades. The dam has not grown at the same rate. In normal conditions, this doesn't matter. But in a flood condition, a mass redemption event, the relative size of the dam matters enormously. Let me tell you about a completely different market to show you what this mechanism looks like when it breaks. In February 2008, there was a type of short-term bond called an auction rate security. Municipalities, hospitals, universities, and corporations issued these instruments to raise capital. Investors bought them because they were sold as safe and effectively liquid. You could sell them at weekly auctions, essentially cash equivalents with slightly better yields. Major institutions ran these auctions. The system worked flawlessly for over 2 decades. Then, in a single week, in February 2008, the auction market froze. Not gradually, not over quarters. In a week, $330 billion in supposedly liquid investments became completely untradeable, essentially overnight. Not because the underlying municipalities went bankrupt, not because the bonds defaulted, because the mechanism that provided liquidity, those weekly auctions, collapsed the moment the big banks stepped back and there were not enough buyers to clear the market. The mechanism was the problem, not the underlying asset value. Index funds have legal redemption mechanisms. ETFs have in-kind transfer structures specifically designed to handle high redemption volume. I am not saying they freeze, but the speed and depth of a price decline can be severely amplified by mass redemption in passive vehicles because the mechanical selling does not pause to consider valuation. It just sells. We saw this in the March 2020 crash, which saw the market drop 34% in 33 days faster than the 2008 financial crisis, which had a much more severe underlying economic cause. The speed of the 2020 crash was at least partly a function of passive and algorithmic selling pressure. The Fed intervened in an unprecedented and extremely rapid way, and the recovery was unusually fast, but the fragility was real. And the structural question nobody can answer confidently is what happens in the next crisis if the Fed's tools are already constrained. Here is the demographic time bomb layered on top of this. Baby boomers, now aged 61 to 79, hold an estimated $40 trillion in retirement assets, much of it in passive funds through 401ks, IRAs, and target date vehicles. As that generation ages into required minimum distributions and retirement spending, those assets flow out of the market every year. This is not a prediction or a hot take. This is actuarial math. The boomer generation has been the single largest contributor to market inflows for 30 years. The reversal of that flow is a structural headwind that compounds every year for the next 2 decades. When that capital exits from passive funds, the funds sell mechanically, they sell proportionally. They sell regardless of what NVIDIA reported last quarter. And if that demographic selling wave overlaps with an external catalyst, a recession, a credit event, a geopolitical shock, the amplification effect could produce drawdowns that look historically anomalous, but are actually structurally predictable. By the way, hit subscribe if you like this kind of breakdown. YouTube's algorithm is genuinely opaque, and if you don't subscribe, it may never show you my videos again. This is also where I want to introduce someone who has been on my mind while I've been building this video. Call him Marcus. Marcus is 42 years old. He makes $120,000 a year in middle management at a logistics company in Ohio. He has been dutifully contributing 15% of his salary to his 401k for 12 years. He did everything the books told him to do. He ignored the hot tips at the office. He put everything in a target date 2045 fund and didn't look at it for months at a time. He is, by conventional financial advice standards, the responsible guy who's supposed to win. Marcus has $240,000 saved. He feels good when he checks the app. But here is what Marcus's portfolio actually looks like under the hood. His target date fund allocates roughly 82% to equities, of which 65% is US large cap, which means approximately $156,000 of Marcus's money is in US stocks. And of that amount, roughly 35%, $54,600, is concentrated in 7 technology companies. Marcus thinks he is diversified. He is making a concentrated tech bet he never consciously agreed to make. His fee on the target date fund is 0.15% annually. That sounds harmless, but over 23 years, at 7% average returns, Marcus will pay approximately $42,000 in fees on his current balance alone, not counting future contributions. That is not catastrophic, but it is a decent car, and it is leaving his portfolio without him noticing. The fund is also not wrong for Marcus in its broad construction. His actual problem is a structural one that compounds everything else. Marcus has no cash buffer outside his retirement account. If he loses his job, he draws down the 401k early, pays the 10% penalty, pays income tax on the withdrawal, and potentially sells at the worst possible time. His financial structure has no shock absorbers. The Escalator is carrying him, but one unexpected repair bill or job loss, and he has to step off mid-ride. Marcus is the person this video is for. Not because he's made dramatic mistakes, but because he's done everything conventionally right and still has structural vulnerabilities he doesn't know about. Now here is the piece of the conversation that the bubble theorists, the Michael Burry fan accounts, the gold standard Twitter accounts, the newsletter writers who've been calling for collapse since 2014 always get right about the mechanics and catastrophically wrong about the solution. The concentration is real. The liquidity risk is real. The price discovery changes are real. But their implicit answer is always some version of hire smart active managers who can navigate this. And this is where I get off the train completely. S&P's SPIVA report, published every year, tracks active versus passive performance across every major category. Over any 20-year rolling period, approximately 85 to 90% of actively managed US large cap funds underperform the S&P 500 after fees. Not a narrow majority, 85 to 90%. And the few who outperform in one decade rarely sustain it in the next. Research from Morningstar shows that past performance in active fund management has essentially zero predictive power beyond 3 years. The alpha, when it appears, looks like luck in the data. The fee math makes the problem concrete. If Marcus has $240,000 and pays 1% annually in active management fees versus 0.15% for his current target date fund, here is what that costs. Over 23 years, at 7% annual returns, at 1% fees, his $240,000 grows to approximately $1,200,000. At 0.15% fees, it grows to approximately $1,420,000. The fee difference costs Marcus approximately $220,000, not because the active manager did anything wrong, just because compounding is brutal and fees are forever. The active manager would need to outperform the index by roughly 0.85% per year, consistently every single year for 23 years, just to justify the fee difference. The data says that is extraordinarily rare, and you have no reliable way to identify those managers in advance. So passive is structurally flawed, concentrated, momentum-prone, potentially illiquid in crisis, and active is expensive, statistically unreliable, and requires you to correctly pick not just the right manager, but the right manager in advance of their good period. This feels like a trap with no exit. It is not. The exit is right here. But here is what nobody is telling you. And this is the part of the conversation that is most intellectually honest about where the real damage happens. The standard defense of index funds, from Vanguard, from the academic literature, from every finance professor, is that passive funds free ride on active price discovery. Active managers do the work of figuring out what a company is worth. Passive funds accept whatever price gets set and pay almost nothing for the service. As long as there is enough active capital doing the work, the prices stay roughly accurate. This logic is correct, and it has been correct for decades. The question is whether it remains correct at 50% passive. Nobody knows. There is no formula. The Bank for International Settlements published research showing that measurable price discovery quality has declined in segments of the market with high passive concentration, particularly in smaller stocks that are lightly weighted in indexes but still included. Analyst coverage of these companies has dropped. Trading volume has dropped. Bid-ask spreads have widened. The feedback loop that corrects mispricing has become slower and less sensitive. Here's a way to think about it. Imagine a small town with 10 independent real estate agents, all of them doing their own property assessments, competing for listings, building their own models of what each neighborhood is worth. Now imagine that 7 of those 10 agents retire and are replaced by a software tool that automatically prices every house at whatever the previous agent priced it at, adjusted for the broad market trend. The 3 remaining human agents are still there. They are still doing real work. But their influence on the average price in the town has been diluted by the mechanical copying. When something changes in the neighborhood, a new highway gets announced, a flood zone map gets redrawn, the price discovery is slower because 7 out of 10 price setters are just copying yesterday's number. That is a simplified picture of what passive dominance does at the margins of the market. The system doesn't break, but it becomes somewhat less responsive, somewhat more prone to momentum, and somewhat more likely to let mispricing persist longer than it historically would. Companies inside the index get capital regardless of whether they deserve it. Companies outside the index get starved of capital regardless of their quality. This creates structural distortions that accumulate over time. The irony of passive investing is that the hardest part of doing nothing is doing nothing. Some people pay a financial advisor 1% per year specifically to be the person who calls them during a crash and says, put the phone down, go outside, do not log into the account. This is, in certain cases, genuinely worth it. Now let me tell you where this all actually lands. Because everything I've described, the concentration, the liquidity mechanics, the price discovery, is actually the warm-up for the main event. The real bomb is not in the market structure. The real bomb is in your brain. Dalbar, a financial research firm, has been tracking the actual returns of retail investors versus the returns of the funds they invest in for decades. Their data shows consistently that the average equity fund investor earns approximately 2 to 2.5% less per year than the funds they hold. Not because they chose bad funds, because they buy after markets go up and sell after markets go down. They react to the environment instead of the plan. They watch the app during a crash, feel the cognitive weight of the losses, and sell near the bottom, then wait until the recovery is well underway before buying back in. They reliably transfer wealth to the investors who do nothing. Over 20 years, a 2.5% annual behavioral gap is devastating. A $100,000 investment at 7% annually grows to $538,000. The same investment at 4.5%, 7 minus the behavioral drag, grows to $242,000. You lose $296,000 not because the market failed you and not because your fund was wrong, but because you were the most expensive line item in your own portfolio. Richard Thaler's Nobel Prize winning research on loss aversion gives you the neural mechanism behind this. The psychological pain of losing $1 is roughly twice as intense as the pleasure of gaining $1. So a 40% portfolio drawdown is not experienced as I'm down 40%. It is experienced at approximately the same cognitive intensity as the pleasure you would get from an 80% gain. That is the actual emotional load you carry when the market is crashing. And passive investing, which is technically the right strategy, does almost nothing to prepare you for that experience. It just tells you to hold. It doesn't tell you that holding through a fast 40% drawdown feels approximately like your house burning down in slow motion. Now combine that with the structural risks I've described. If the next major drawdown is faster and deeper because of passive fund mechanics, and there are real reasons to think it could be, then more people hit that psychological breaking point. More people sell. The mechanism of the market amplifies the mechanism of human psychology. And the result is the same thing it has been in every market crisis in history. A massive wealth transfer from people who panicked to people who had the structure in place to do nothing. Marcus, in Ohio, checking his app every morning since he did the math on his tech concentration, is already exhibiting the behavior pattern that costs investors the most money. The right response to discovering a structural vulnerability is not daily surveillance. It is to fix the structure once, clearly, deliberately, and then not think about it again for a long time. Marcus needs to stop watching the app, but he also needs to fix the allocation. Both, not one or the other. Because right now, Marcus has neither the right structure nor the right behavioral posture. And those two problems compound each other. The escalator doesn't know when to stop, but you get to decide where you stand on it. 3 specific moves, calibrated to exactly what I've described. Not generic, not motivational, real. The first is breaking the cap weight monopoly in your equity allocation. The concentration risk, 35% in 7 companies, is specific to cap-weighted US, large cap indexing. A total world market fund, something like Vanguard's VT, gives you the same passive, low-cost, rules-based exposure, but it dilutes that 7 company concentration from 35% down to roughly 14%, because non-US markets don't share the same tech dominance. European equities are trading at CAPE ratios of around 14 to 17 right now. Emerging markets lower still. The S&P 500 CAPE ratio has been running north of 35 for the past 2 years. You are not abandoning US stocks. You still own Apple, still own Microsoft, still own Nvidia. They're just a smaller proportion of a bigger, more diversified machine. The passive logic is intact. The cost is essentially the same. The concentration risk is cut roughly in half. The escalator still goes up. You've just distributed your weight more evenly across its structure. The second move is adding a small cap value tilt of 10 to 20% of your equity allocation. This is not stock picking. This is changing which rules-based index you track. A small cap value fund, DFA, iShares, and Vanguard all offer versions of this, buys companies that are cheap relative to their earnings or book value, rather than companies that are large relative to the total market. Academic research from Eugene Fama and Kenneth French in 1992, substantially updated and replicated since, shows that this value premium and size premium have been persistent over 30 and 40-year investment horizons. Not every year, not the last 15 years, but over the actual time horizon that matters for retirement wealth building. More importantly, small cap value and US large cap growth are not highly correlated. They do not move together in the same direction in the same environments. This is what genuine factor diversification looks like. Not different company names carrying the same underlying risk, but different underlying risks that offset each other. The third move is building a genuine cash buffer and bond allocation that matches your actual risk tolerance rather than the one you think you have when markets are going up. The real test for risk tolerance is not a questionnaire with hypothetical scenarios. The test is this. Could you watch your brokerage account lose 40% of its value over 6 weeks and not sell a single share? For most people, the honest answer is no, which means you need a structural buffer that makes the forced sale unnecessary. Enough in short-term bonds or a high-yield savings account that you can pay your bills and maintain your lifestyle for 12 to 24 months without touching your equity positions during a drawdown. Not because bonds earn more, they typically don't, but because they convert a potential panic sale into an optional rebalance. And rebalancing into equities at the bottom of a crash, selling the bonds to buy more stock when everything looks terrible, is how long-term wealth is actually built. I know someone who demonstrates this perfectly. He's in his mid-50s, runs a landscaping company in Georgia. Call him Pete. Pete watched 2008 unfold with 30% of his retirement in bonds because his advisor insisted on it. He called his advisor almost every month saying he was leaving money on the table, that he should be 100% in stocks. He thought his advisor was being overly cautious at best and incompetent at worst. When the market dropped 50% in 2008 and 2009, Pete didn't lose everything. He lost 35% on his equities and gained a small amount on his bonds. More importantly, he had dry powder. He rebalanced into equities near the bottom of the crash, buying stocks at half price with his bond allocation. When the market recovered, Pete's gains were amplified by the shares he had purchased at the lows. Pete retired at 61. Pete's story is not dramatic. He didn't time anything perfectly. He didn't pick any winning stocks. He just had the right structure in place before the crisis happened, and the structure did the work while everyone else was panicking. The structure was always the answer, not the prediction. Marcus made his changes. He shifted 20% of his equity allocation to an international total market fund. He added 15% small cap value. He built a 12-month cash buffer in a high-yield savings account outside his retirement accounts. He wrote a one-page investment policy statement on a Sunday afternoon when the market was up and he felt calm. It says exactly what he will do if his portfolio drops 20%, 30%, and 40%. The answer for each scenario is the same. Rebalance on schedule. Do not sell outside the plan. Do not check the account more than once a month. He did not do this because he believes the bubble is popping this year. He did it because his previous structure was carrying risks he had not consciously accepted, and he had the intellectual honesty to see it once someone showed him where to look. Marcus's escalator still goes up. He's still on it. He's just standing differently on it. The market will eventually test everyone, not your knowledge, not your fund selection. It will test whether you can sit in a room with your account down 40%, looking at a written plan you made in a calm moment, and do nothing except rebalance on schedule. That is the entire game. Every piece of financial structure you build should point toward making that moment survivable. Lazy investing built more fortune than crypto memes. And if that sounds too boring to be true, just remember that boring is the one thing Wall Street has never figured out how to charge you a management fee for.